Good morning, everybody.
Good
Just
morning.
wondering, how are you guys doing this morning?
All right, so you know.
I'm very glad. I just wanted to check that you can hear me, but it sounds like you can. So I have started recording. So I'm just going to share my screen with you so you can see the slides. Shout anytime if you cannot hear me, but I think everything seems all right. Oh,
Miss Jordan, your sound is very, very bad. Hey, it's very harsh. Like,
Yes, I was about to say.
yes, please.
and now better?
Maybe try speaking in a sentence.
Okay, so I'm going to share my screen with you, and you can just let me know if the sound sounds a bit better.
Maybe if you reduce your volume speaker.
Oh, okay, let's try.
Or if you have a set of headphones, maybe the volume on the headphones is too loud.
I'm just looking to see where I can reduce. Okay, I did reduce it a bit. Is it better now?
Yeah, it comes and goes. It becomes better and then it goes back to its original distorted self.
Okay, I'm going to start. Let's give it 2 minutes. If it's still bad, let me know.
Sure.
I'm just thinking to see what possible settings I can change. Is it better now? I'm not using headsets. Let me leave the meeting and come in again. I'm just surprised because I've never had this problem before. So let me leave the meeting, come back in again. Maybe something went wrong.
Yeah, maybe you must try use headsets.
I'm just going to leave the meeting and come back in again. Any chance better?
It's actually
Sounds
worse
like
now,
you.
hey?
Sounds like Are you perhaps outside? Because it sounds like there's a bit of echo, not even a bit. There's some echo in your background.
I'm not actually outside. I'm just surprised that it's giving such problems.
We can now hear the aircon or something like that.
You might use earphones.
I don't actually have headsets near me. I'm going to share my screen with you. Maybe somebody can help me have a look at my settings.
Sounds like you're in a really big room with a big window open.
Can everyone see my screen?
Yes.
So I'm just going to open this.
Just go to your mic settings.
Sorry, say again, my mic settings.
Yes.
Here at the bottom or here at the top?
At the top.
Okay.
See maybe. And then there's spatial audio. Just
Yes.
select that
Okay.
and switch that off and switch on noise suppression, the one below it.
Like that?
Yeah, that's better.
Oh, thank you so much. Is that better, guys? I hope so.
Yes, much better.
Awesome.
Just try switch on noise spatial audio.
On, okay.
See, does that make a difference? Just speak.
Does it make a difference, everybody?
Yeah, that's even better.
Okay, so do you think we're good to go?
Yes, thank you very much.
Okay. Sorry, guys, I do apologize for that. So I'm just going to stop sharing my screen with you while I just get my slides open. I'm going to keep these settings on. I don't know what went wrong with my settings, but thank you so much for that assistance. Okay, so slideshow from the beginning. And can everyone see my screen? Yeah, just shout if you can't see my screen.
Just to confirm, yes, we can see your screen. You can go.
Thank you so much. Okay, so good morning, everyone, once again, for those who have joined us. And thank you for the assistance for getting my sound a bit better. Today's class, we're going to be looking at Assessment 3, a little bit of preparation for Assessment 3. You're welcome to also post your questions in the chat. In your previous classes, I know we did say raise your hand. However, I can't really see your hands because I've got the slides in front of me. So we can make it a bit more informal. You're welcome to stop me as we go along, that type of thing. And then if after the session you realize you have a question or two, you're more than welcome to email us at our 3764 email address. Okay, so what are we going to do today? We're going to look at specifically, I've identified a few areas which the students struggle with. Specifically, we're going to cover a little bit of financial instruments today, and then consolidated financial statements. There's a few class examples that we're going to work through, and then we'll look at some questions. Okay, so as you guys know, assessment 3 will be written on Tuesday, the 19th of August. Paper download starts at 8:15. You will then write from 8:30 to 10:30, and you will then upload your script back to us. Please, I know this time we did make exception and we did request the Invigilator app scripts. However, we cannot always ensure that they will be available to us. So as far as you possibly can, please submit on the My Exams portal. Then assessment 3 carries 60 marks and covers learning unit 1 to 8. Okay, please note the handwriting still applies. So please handwrite your assessment. You guys did very well in assessment 2 with the handwriting. In fact, I can't think of one script that I wasn't able to read. So don't worry about your handwriting, we can read it. Just please make sure that you do handwrite and submit on the My Exams portal. Okay, we have made an announcement on My UNISA, but just very important. I'm not sure if you guys are aware, probably not yet, because we actually only found out ourselves recently, but the Invigilator app has undergone a software update. So please update your Invigilator app software before Tuesday. If you have any queries in this regard on how to do it, we haven't been given that information, but please contact us or the Invigilator app guys who will assist you if you are not able to do this Invigilator app software update. Okay, so just to open the floor and to break the ice a bit, how have you guys found specifically financial instruments? Because that is one of I know students do struggle with financial instruments, and for that reason, we're going to look a little bit at financial instruments this morning. So how have you found working through chapter 1, specifically the financial instruments learning unit? Are you guys okay with it? Is there anything specifically that you struggle with? Any comments that you would like to make?
Can I maybe say something?
You may.
The disclosures for me, well, I think in general, I battle with it in principle, but the disclosures as well, knowing how to do it
is difficult.
Yeah.
And also, we're going to have a look at, I know it's often asked, but something that's often asked, well in fact, on 3764, it is often asked because we asked it in last year's examination as well, or last year's final assessment, is compound financial instruments. And we're going to have a look at some examples today, and you'll see that compound financial instruments, as daunting as they sound and as difficult as the standard reads, are actually not so difficult once you understand the principles behind what you're doing. So we're going to have a look at some compound financial instruments just now. We're going to look at a complete example of compound financial instruments, because that is nice to ask because of the liability and equity component. You are testing two principles at once. Okay, so to get to some definitions, I know IAS 32 defines financial instruments. It defines what financial assets and financial liabilities and equity are, and the way that they word it is not always easy. They don't word it in a simple format. So we're going to try and break down some of those definitions this morning as well. So IAS 32 says, what is a financial instrument? And this is important for theory questions, because if you have a theory question that asks you to discuss the recognition and measurement of a financial instrument. Before you're able to recognize or measure it, you need to know whether this thing meets the definition of a financial instrument. Thereafter, you would break it down and say, okay, we know this is now a financial instrument, but is it a financial asset? Is it a financial liability? Is it an equity instrument? Or is it a compound financial instrument? So, chapter 21 in your grip and GARP, that's very important that you guys do have the textbook and that you work through it, covers financial instruments. Hedge accounting, luckily, is out of your syllabus. And if you refer to Learning Unit 7, we have included the excluded sections for you. There are quite a lot of sections that are excluded for you on a third year level that you'll only do next year on CTA. And also there are quite a few that are excluded by CICLA in total, which means it's not part of the CICLA examination examinable pronouncements, which means that you won't even do it on CTA level either. It's excluded from CICLA's exams completely. Okay, so we have made a list for you under Learning Unit 7, which you can leave out. Okay, so we know now that a financial instrument is a contract that gives one guy a financial asset and the other guy a financial liability or an equity instrument. So who would have the asset in their books? And this would obviously be the investor or the holder. We use the term investor more when it has to do with shares, and we use the term holder when it has more to do with a debt instrument. But it's the investor or the holder, the guy that purchases this instrument, actually has the asset in their books. Yes.
Sorry, ma'am, just sorry to interrupt. I think some of the words are clipping away. I don't know if one can just try again at one of the other settings with your sound. It's much better than what it was, but it sounds like you're very, very close to the mic and some of the words break away.
Okay. Would you like me to close my slides and we have a look at the settings again?
If possible.
That's no problem. Okay, yes, you're more than welcome to, you can guide me on this.
If you could just share your screen on. Don't see anything yet. Oh, yes.
Okay, let me just close these slides or open here. Okay.
Just on the mic, if we can, on that drop down where we were last time. And just turn off that spatial sound.
Okay. And then I know, shall we see somebody says it sounds like I'm in a storm with the birds chirping. Okay, I do have the door open. Let me just go and close the door as well.
Sorry.
That's fine. I want you guys to be able to hear me nicely.
Okay. If we can just try one with on the audio settings there, more audio settings.
Okay, so I hope the birds are out. Okay, yes, you can tell me again. I'll change the setting.
So on the more audio settings.
Yes.
Just below that, if you click on it.
Do you think I should switch this on?
We can try. It just sounds like your mic is very sensitive.
Okay. You can tell me. Can I turn it off?
Yeah. I don't think there's much more we can do. Unless somebody else has a suggestion.
I'm opening the floor up to any suggestions.
You can try the spatial audio again and then see now that the door's closed.
Okay. Let's do that.
It sounds better. I don't know if anybody else feels that way.
Do I sound a little bit better? I really hope so.
Yes, much better.
Yeah, that's fine.
Does sound better.
Sorry for the interruption.
No, I'm glad you did. Okay, so now let's just think. I'm just going to go back to my slides. I'm just going to close there. Okay, so we spoke a little bit about the financial assets, and then we said the financial liability was the issuer or the borrower. So he's the guy that borrows the money or issues the shares, and therefore has to obviously pay back the interest, pay back the capital, and he's the guy that issues the shares. So he'll have the equity component in his books as well when he issues his own shares. Then we have compound financial instrument. This includes both the financial liability and equity components. Often, well, not often, majority of the time, these financial instruments are debt instruments that, or preference shares, we'll look at both, that are convertible into ordinary shares. When this happens, you might have a compound instrument, in which case you're going to have a financial liability in your books, which will incur finance cost and interest. You will also have an equity component, as this is a compound instrument. And you can see how you have this equity component simply because in the end, you might possibly have to issue your own shares. So the first step, which is actually a very simple step, is to first determine who's the issuer, so who issued this instrument and who is the holder. Because then you know whether you are working with a financial asset or a financial liability or a compound instrument. Okay, so the financial asset definition. A financial asset is defined as either cash, we know the cash, that's the easy one, or equity instrument shares in another entity. So if we own shares in another entity, that's a financial asset for us. Any contractual right to receive cash, for example, debtors, accounts receivable, that's a contractual right to receive cash in future when the debtor pays us. And then you won't come across this so much, but a contractual right to exchange financial instruments under potentially favorable conditions. So on a third year level, you can expect to see investments in debt instruments and investments in equity instruments. You're not going to see derivatives and all those fancy things yet. So just to recap, because I'm sure you guys have seen this, financial assets are often classified into 4 pillars or classifications. And the first one is when we say, okay, now we've got this financial asset. Are we going to classify it at amortized cost? Are we going to classify it at fair value through P&L, profit and loss? Are we going to classify it at fair value through OCI, other comprehensive income? Or are we going to have debt instruments classified at fair value through OCI? Okay, you don't often see that. The ones that you do often see is amortized cost. This is your bonds. This is when you do your calculation where you have your future value and your interest and your payments per annum or whenever the payments are, and then you compute your present value. That is when you, and then you have an amortization table. That is when you're working with your asset at amortized cost. This is solely principal and interest, cash flows on specific dates. Then you have fair value through profit and loss, which is usually shares in other entities held for trading. So if you buy shares and you hold them for trading, and you trade with these shares, you hold them for to buy and sell, then you're going to classify these shares at fair value through profit or loss. At fair value through other comprehensive income, these are things like investment in subsidiary, where you buy an 80% interest in a subsidiary in order to obtain control of that subsidiary. That's not held for trading, and therefore these shares will be classified at fair value through other comprehensive income. And then what you won't see often at fair value through other comprehensive income is debt instruments, which we know are solely principal and interest cash flows. But you hold these for the objective to collect the cash flows and sell the assets at the end. Okay, you don't see these often, but if you do, these are fair value through other comprehensive income. And all that means is when you fair value these assets, let's say we increase the value of these assets, we're going to debit the asset. We're not going to credit profit and loss, we're going to credit our other comprehensive income. And this other comprehensive income is obviously equity, and we usually call it something like mark-to-market reserve. Okay, so all mark-to-market reserve is an equity account. So it's like a revaluation surplus when you have an asset. It's an equity account that is used when we revalue these investments. Okay, so financial liability. There's a hand. I can actually see your hands as you probably can see. So you're welcome to ask.
Morning. I just wanted to ask that fourth classification.
Yes.
You said to us it's not usual. The first three are usual. Is
Correct.
it something that we need to really know? We know about it. You are telling us. We understand. But is it something that is examinable for this course?
You know what? Have a read over it, but I wouldn't say it's something that you really need to know, especially now for assessment 3 and probably for the rest of the year as well. But make sure you read it, because
We
when
need to
you
know. Yes.
because when you get to CTA next year, you don't want to see it for the first time.
Okay. Thanks.
But it's definitely not, as you know, the debt instruments and the financial assets are usually, especially the debt instruments, are usually at amortized cost.
Good morning, ma'am.
Morning.
Hi. So with these 4 classifications, I just missed which one should we just read through and just have a knowledge and just be aware of?
The bottom one, the debt instruments through OCI.
Okay, the debt instruments through OCI. Okay, thank you, ma'am.
Okay, financial liability definition. Now we have a contractual obligation to deliver cash. Example, accounts payable.
It's fine. Sure.
Okay.
we have a contractual obligation to exchange financial instruments under potentially unfavorable conditions. Then, very important, a contract that will be settled in your own shares that involves a variable number of shares. So what does that mean? It means that the number of shares that you might need to give is dependent on something like the gold price, the value of the rand, something that can vary. It's not fixed. It goes up and down, it goes in all directions, and then you decide on a certain date, okay, what is the price of gold today? Therefore, I'm going to settle it with X amount of shares.
Can I ask a question?
You may.
If you've got an obligation to pay employees future shares, and those shares will accrete or will decrease depending on the value of those shares, will that form under the contractual settlement or of own shares? Or will it fall somewhere
That's not something that's under employee benefits.
Okay.
That's not really something, that'll fall under employee benefits. This is, we're talking about someone that has some sort of instrument that will be settled in a variable number of our shares. That is a financial liability. So it's almost as if our shares are used as currency. Okay. As opposed to a fixed number of shares where it says, okay, you have 2,500 bonds, and each of these will be settled by one share. We know exactly how many shares we're going to have to issue at the end. And if we know exactly how many shares we need to issue at the end, we're going to settle in a fixed number of shares. But if we don't know exactly how many we're going to settle in at the end, we have a variable number of shares. And as soon as we're settling in a variable number of shares, we're going to have a financial liability. And if we settle in a fixed number of shares, we're going to have an equity instrument. Okay, we will look at an example just now when we come to compound financial instruments. Financial liabilities are a bit more simple because we have our two cylinders. The first one is at amortized cost, which are usually your bonds and debt instruments. And then at fair value through profit and loss, these are more the trading. Okay, so compound financial instruments. I haven't gone through all of the examples of assets and liabilities because that is not really the purpose of today. If you want to go and have a look at assets and liabilities on their own, please refer to the previous discussion class that covered financial instruments. Today, we're specifically looking at compound financial instruments because I know this is often where the students struggle. And the issuer of the compound financial instrument must split between debt and equity. Okay, now how do they do this? How do we know when we issue this compound financial instrument? So we're the issuer. So we received money. So we debit bank. What do we credit? Do we credit financial liability? Do we credit equity? Do we credit financial liability and equity? And we said that for there to be an equity component, so in order for this compound instrument to have an equity component, in other words, to be a compound instrument, because a compound instrument by definition has this liability and equity component. this instrument must be convertible into a fixed number of shares. So as soon as we have an instrument that's convertible into a fixed number of shares, we know that we have this equity line item as well. So if it's convertible at the option of the holder, who's the holder? If you are the holder of this convertible instrument, which side are you sitting on? Did you buy this instrument or did you sell this instrument?
Bought it.
You bought it.
Instrument.
Put yourself in this guy's shoes. You bought this financial instrument that's convertible into shares at your option. In other words, you can decide, are you going to take the shares or are you going to take the money and run?
You'd probably take the money.
You'll take the money and run, exactly. So when calculating the liability component, and the option and the holder can choose at the end of this term, does he want the shares or does he want to take the money and run? We always assume that the holder will take the money and run. So I'm going to pause, and because I see there's a couple of hands. You're welcome to start to ask your question.
Oh, hi everyone.
Hi.
Hi. So I wish to ask regards to the financial asset and the financial liabilities. So under the accounts receivable and the accounts payable, is it the receivable? Is it the debit and the accounts payable? Is it the credit? I wish to confirm that.
Correct.
Okay, noted. Thank you very much.
Okay, so now let's look at the side of the issuer. This is the guy that issues or gives this instrument. If you were the issuer and at the end of the term you had the option to give your own shares or to pay the cash, which would you take?
Give shares.
Exactly. No one wants to part with their hard-earned cash. You rather give them the shares, which means that when you calculate the liability component and it's convertible at the option of the issuer, we will always assume the issuer will say, leave my money alone, take my shares. So now that we know there's 3 steps that need to be followed in working with a compound financial instrument. Now, the first step is to determine the fair value of the instrument as a whole. So what is the fair value of this instrument in its entirety? And this is usually the transaction price. Step 2, we say determine the fair value of the liability component. So we always determine the fair value of the liability component first. Then, in terms of the definition, equity is the residual. So fair value of the whole instrument minus fair value of the liability component equals fair value of the equity component. And why do we need to split this? because when we account for it, we're going to say debit 2.5 million or however much we received, bank, credit, liability component of financial instrument, credit, equity. Okay, we're going to have a look at an example of this. Okay, I'm going to give you a minute or two to read this. I'm going to read all, so yeah, you can decide. I'm going to read it slowly. But yeah, so we can read it together, it's fine. So we issued, us being Smooth Care Limited, issued 2,500 convertible debentures. Okay, so we already know just by the words that these are debentures, i.e. bonds, and they are convertible. Okay, what are they convertible to? Well, okay, first of all, they've got a fair value of 1,000 rand each, and they were issued at their fair value, which is usually the case. The debentures have a face value of 1,000 rand, so the face value is what you're going to use to calculate this annual payment, and bear a fixed coupon interest rate of 9% per annum. The coupon interest is payable annually in arrears. The debentures are convertible at the option of the issuer on 30 September 2026 at a ratio of 1 ordinary share for every debenture held. Okay, two things. Do we have an equity component? Yes or no?
Yes.
Why?
Because the debentures can be convertible into equity or shares.
And specifically, what number of shares? Fixed or variable?
Fixed.
Yes.
This is 1-to-1.
Exactly. We know exactly from the start. We know exactly how many ordinary shares we're going to have to give them at the end of this, if obviously the issuer chooses the shares. So we definitely have an equity component here. Do we have a debt component? Or a financial liability component, I should actually say. Yes, because we have a contractual obligation to deliver cash at the rate of 9% per annum.
Would the debt component only be the compound interest?
Depends, but you're right, yes, you're right. But I want to take a step back. Why only the compound interest? Why not any future value? Why not, if I can, whose option, or who has the option to say, okay, we're now going to convert these shares, convert these debentures into shares? Who has the option?
The issuer.
It's at the option of Smooth Care.
Yes. Now, Smooth Care Limited, what's he going to do? Or what does the standard say we must assume he's going to do?
We would assume that it was just issue shares instead.
Exactly. Exactly. We're going to assume that he's going to issue he's rather going to give his shares than his hard-earned cash. So when you calculate, I don't want to jump the gun too far now, but when we calculate the liability component, that will be this fixed coupon rate of 9% per annum. The equity component will then be this fixed number of shares we need to issue at the end. So we know now from reading this information that we are dealing with a compound financial instrument. What happens if this was not a fixed number of ordinary shares? Would we have a compound instrument?
No.
No, what would we have?
No.
Financial
Pure
liability.
liability.
Yes, well done. Well done. We would have a pure financial liability. So let's go.
Sorry.
Yes, yes.
Fair value and face value, that's the same thing.
So say that again?
Face value and fair value.
No,
Face
not
value.
always, not always.
Issue value.
Correct. These were issued at their fair value.
So it is coincidental that it's the same as.
Correct.
Okay.
It's usually the same, but the interest is calculated at the face value of the debenture.
Okay, thank you.
So this question says prepare all the journal entries, but we are going to prepare the journal entry basically to account on initial recognition for this convertible debenture. So let's do our steps, because it's easy to do compound financial instruments if you follow the steps. So what did we say step 1 was? Determine the fair value of the instrument as a whole, usually the transaction price. So we say, okay, we issued 2,500 debentures at R1,000 each. So how much money did we receive? We received 2.5 million. So 2.5 million will be debited to our bank account. Step 2. Determine the fair value of the liability component. So we have our payment of 9%, if we go back to our question. This bond bears interest at 9% per annum. So 9%, basically times 1,000 times 2,500 is 225,000 Rand. So we're going to be paying 225,000 Rand per year interest on this. The standard says when determining the fair value of the liability component, we need to use, and I want to go back to the question, a market-related rate for similar debentures without the conversion option. So we will always give you this rate in a question. We will say a market-related interest rate for similar debentures without the conversion option. In other words, without the option for the shares, without the share clause in it at all, is 11.5 per annum. And this is the rate that you use to discount these annual interest payments. Okay, not the 9%, we use 11.5%. For 5 years, if you calculate the number of years that this bond will be an issue for, we're going to get 5 years. Then very important, future value. Are you going to pay anything in cash at the end of this 5-year period?
No, because
we're not
to issue the shares.
Exactly. It is always assumed that when the issuer has a choice between paying out money and issuing their own shares, they will always go with issuing their own shares. So the answer is no, we're not going to pay anything out at the end of this 5-year term. So our future value is 0. And therefore, if we compute our present value, we're going to get 821,223. Is everyone okay with this calculation?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Perfect, thank you. Step 3. What is our value? Well, the definition of equity always has the term residual in it. So equity is the residual after deducting the fair value of the liability from the fair value of the instrument as a whole. So the fair value of our equity is the 1.6 million. So what is our journal entry? Debit? Okay. This question didn't ask for the journal entry, it asked for the correcting journal entry. But if we had to do the journal entry, we would simply say debit bank because we received 2.5 million. Credit liability portion of convertible debenture, we calculated that as 821,223. Credit equity portion of convertible debenture, we calculated that as 1.6 million. So that is basically compound financial instruments when you have a debenture or a bond convertible into shares. So the two very important things that we learned is that in order for there to be an equity component, it must be convertible into a fixed number of ordinary shares. The second thing that we learned is when it is convertible at the option of the issuer, he will always try and keep his money and give his shares. In other words, when calculating this liability component, the future value is going to be 0. If this question was exactly the same, but we said that the debentures are convertible at the option of the holder on 30 September 2026, what do we then assume about what the holder is going to do?
Take the money and run.
Take the cash.
Exactly. He's going to take his money and run. So when we do this present value calc, is our future value still going to be 0?
No.
No. It's going to be the amount that the issuer must pay the holder at the end, assuming now the holder is going to take his money and run, which we always assume when the holder has the option at the end.
Ma'am, can I quickly ask?
Welcome.
Will we always get a coupon rate, or must we calculate the coupon rate for ourselves, or a market rate for ourselves?
You will always be given the coupon rate. I'll tell you why. That's given information in the contract between the two parties. So in real life, one day you will be able to just look at the contract and see the amount. So for that reason, we will also just give you the amount because it'll be there in the contract between the two parties. We will also always give you the market rate for a debenture without the conversion.
But you broke the. What about the market rate? Do we always get it also? Or?
Correct.
Okay. Thank you so much.
Okay, you will always be given both of the rates in a question. You will then need to do this PV calc.
Okay.
Questions?
I have a question. Let's just say that we were given the risk-free annual interest rate. What were we going to do with that in terms of the calculation here?
If you were given the risk-free interest rate?
Yes, ma'am.
Do you have an example like that? Have you seen it before?
Yes, example 333 from the Gripping Gap book.
I'll have a look at that and I'll get back to you. I'll have to just read the scenario.
All right, thank you.
So, ma'am, I just want to confirm something with regards to identifying the equity component. So, when there's a fixed amount of shares that are going to be converted, we can say there's an equity component. So, when there's a variable component, like what's an example of that? What would they say in the question for us to be able to be what's an example of that? Yeah.
Okay, I don't know if there is an example of that in Gripping Gap. I must actually have a look. But it would be something like like I said just now, something like the number of shares that will be issued is dependent on the gold price. Something that goes up and down maybe on a daily basis. So it's definitely not fixed, it's very much variable. But it'll be very clear to you in the question whether it's fixed or variable. And remember, for it to be a compound instrument, it needs to be fixed. So it's not very often that you'll see this converted into a variable number of shares. Mostly it will be convertible into a fixed number of shares because then it will be a compound financial instrument.
Got it, thanks.
In fact, I don't even think Gripping Gap, I must actually look, I don't even think Gripping Gap has an example in it where we redeem it. I'll have a look. I haven't read the chapter from corner to corner yet, but I'll have a look to see if they've got an example where it's redeemed at a variable number of shares.
Sorry, I don't know if this was answered, but
yes,
if the shares are in the options of the holder, so they would convert. Does that change the whole thing to an equity instrument?
Okay, now he's welcome to ask his question. You can just shout out when I think he might be muted.
If the option is in the hands of the holder, does that change?
So, on this whole compound financial instrument topic, certain preference shares can also be compound financial instruments. And now, how can this be possible? If we look at the definition of a financial liability and equity instruments, we know that preference shares may have a non-discretionary dividend. What does that mean? What does the term discretionary mean? And what does the term non-discretionary mean?
They can decide whether they will issue it.
Yes. If it's discretionary, it means you have the option. I can use my discretion, for lack of a better, and say, I don't want to give you a dividend this year. If it's non-discretionary, sorry, you don't have an option. You need to pay your preference dividends.
And if it's a cumulative, will we see that or not?
Well, cumulative doesn't make a difference, but yes, you will see that. But whether it's cumulative or non-cumulative, is irrelevant for purposes of compound financial instruments. What is important is whether it's discretionary or not. And we're going to have a look at the next thing, whether it's redeemable for cash or not. So preference dividend may have a non-discretionary dividend. If you think of non-discretionary, it means you must pay. So if you must pay, does the issuer have an unconditional right to avoid the payment of cash? Which is the terminology used in IAS 32?
No.
They don't. The issuer must pay the cash. The issuer must pay the dividend. So can you see that these dividends are going to be paid over 5 years or however many years, is a financial liability?
Yes.
What about if you can have discretion over whether you're going to pay the dividend or not?
Then it's not a liability because there's no obligation.
Exactly. You don't have, just to go back, IAS 32 talks about the unconditional right to avoid the payment of cash. Do we now have the unconditional right to avoid the payment of cash?
No, there won't be any right.
We do not have to pay the cash, so we do have the unconditional right to avoid the payment of cash. So it's an equity instrument. Okay, so must we pay the money or not? If we don't have to pay the money, it is equity. If we do have to pay the money, it is a liability. Okay, preference shares may also be redeemable for cash. If it's mandatory redemption, in other words, you must redeem for cash, can you see you've got a financial liability on your hands? If it's convertible at the option of the holder is the guy that owns the preference share. Will he redeem his preference share for cash?
Yes.
Definitely. He's going to take the money and run. If the issuer has the option, what will he do? We will always assume the issuer will prefer to keep their cash. And this term is the prudence principle.
If they issue the shares, is it because then they actually share the risk?
So just ask your question again.
If they, obviously they're going to choose to issue shares.
Correct.
The reason for that is because then the holder shares in the risk.
It's simply that they don't want to issue their cash.
Okay.
They want to keep their money. So if the issuer can decide if these preference shares are going to be redeemed for cash or not, the issuer will always take the cash option.
Okay.
So the issuer will always take the share option to keep their cash. So can you see that preference shares have two legs? They've got a dividend leg, which may be equity or liability, depending on whether it's discretionary or not. And they've got a redemption leg, depending on whether it's redeemable or not. So let's have a look at some examples, and then this is going to make a lot more sense to you. If these, because if a preference share, if that preference share is mandatorily redeemable, which means it must be redeemable, which means that the issuer must pay the future value that it's going to be redeemed at. No one's got an option here. It's compulsory. But the dividends are at the discretion of the entity. What type of instrument do we have here? So let's look at each leg, because we now know that preference shares have two legs. They've got a redemption leg and a dividends leg. Is that redemption leg equity or a liability? It must be redeemed. No one's got an option here. It must be redeemed.
Liability.
Liability.
Yes. The dividend leg, at the discretion of the entity, equity or liability?
Equity.
Equity.
So
Equity.
you see we have one leg being liability, the other leg being equity. So what do we have here?
Compound instrument.
Yes, can you see that?
Yes.
I can't see that. Sorry about it. I can't.
Next one. Let's have a look at the next one. And as we go, you'll slowly get into this.
Okay.
Let's have a look at the next one.
Okay.
If the principal is compulsory redeemable, so it must be redeemed, the issuer doesn't have a choice. He must pay the cash at the end to redeem this compound, this preference share. Does he have a liability or is it equity for him?
Liability.
Liability.
Yes.
One can say C for compulsory, C for cash.
You can, definitely.
To remember it, if it's compulsory, it's cash.
Yes, and if you don't, and in terms of IAS 32, we have to always talk in terms of the standards. So when you answer questions, then you tell me, you don't say C for cash, C for compulsory. You tell me, because then you won't get any marks. You tell me IAS 32 says if you have if it's compulsory, you don't have the unconditional right to avoid paying cash. And therefore it's a financial liability. So the second one is a financial liability. Both legs of this preference share is a financial liability, and therefore the financial instrument as a whole is only a financial liability. There's no equity component in this preference share. Let's look at another one, the third one. Now we have a principal amount at option of the holder. Who's the holder?
The person buying the shares.
Yes, the person who bought the preference share. What is he going to do? Is he going to take his money, or is he going to say, okay, it's fine, you can give me your old shares?
He's going to take the money.
Yes. So for the issuer, is this a liability or an equity instrument?
The liability.
Yes. Dividend leg, because remember, we always look at the two legs. Dividend leg, at discretion of the entity. When I say entity, I always mean issuer. So is this an equity or is this a liability?
An equity.
Yes. So what do we have?
Compound.
Yes. Next one. Principal amount at the option of the holder. What's the holder going to do?
Going to take
his cash. Take cash.
Yes. Dividends, compulsory. Sorry for you, you have to pay these dividends. Yes. So what do we have?
I have a financial liability.
Excellent. Next one. Principal amount at option of issuer. What's he going to do?
Keep his shares. Equity shares.
He's going to keep his cash, hey?
Yeah.
Oh, yeah, keep his cash.
Keep his cash, so it's equity.
Yes.
Dividend at discretion of entity. Equity or liability?
Equity.
So what do we have?
Equity instrument.
Yes. So can you see that preference shares can be liabilities, compounds, or equity depending on the underlying, terms and conditions. Sorry, there's more. Okay, principal amount. At option of issuer, what do we have?
Take the cash and run. Yeah.
Yes, what's the issuer? What's the option of the issue? What's he going to do?
Take his cash and run.
Remember, not the holder, the issuer. This is the guy who needs to pay the principal or not to pay the principal.
Keep their cash, so they will issue shares.
Exactly. So it's going to be an equity instrument. Everything is compulsory. What is that?
Liability.
The liability.
What do we have?
Compound.
Next one. Principal amount. Non-redeemable at all. So there's sorry for the holder, but it's non-redeemable. So there's no cash going to be paid at the end in terms of the terms and conditions. Equity. Dividend at discretion of entity.
Equity.
So our total instrument is an equity instrument. Last one. Non-redeemable, equity or liability?
Equity.
Done? Compulsory dividends.
Liability.
So what do we have?
But does not be compound.
Compound.
It should be compound, I think.
It should be compound because we have an equity leg and we have a liability leg. And as soon as we have an equity leg and a liability leg, we have a compound instrument.
Can I maybe just ask, if you read the question, how is it best to approach this to identify these components?
Well, I'm just going to use this as an example. This is what your question is going to look like, similar to this, except obviously we're going to be talking about a preference share here. So we would have to be very clear, because we obviously want you to be able to identify the two components and be able to identify whether they are not assets, whether they are liabilities or equity. So we would definitely say, we would need to tell you whether these preference shares are redeemable or not. So the given information would say non-redeemable preference shares, then you know non-redeemable. Or they would say redeemable at X amount. That would be your future value. Then we would tell you that there are discretionary preference shares when it comes to dividends. Or we would say they are non-discretionary and dividends are paid at 8, preference shares, normally dividends are paid at like a percentage of the face value. So all that information is going to be given to you in a question. You will have to decipher which are the two legs, but it'll be in a very similar format to this convertible debenture, where it's clear
from Pick n Pay.
which are your two legs. You'll just have to identify it from the information, which are the two legs. And then you have to determine, is this leg liability or is it equity? And is the dividend leg equity or liability? So and based on that, is this preference share equity, liability, or compound? So now just if these preference shares are convertible into a fixed number of ordinary dividends, we know now that we have an equity component. And if we have mandatory dividends, we know we definitely have a liability component. And therefore, if you have a scenario like this, it's a compound financial instrument, okay, which we know now from our previous list of examples that we did. Okay. Questions? I hope that as far as compound financial instruments go, I remember compound financial instruments giving me a big fright when I studied it. I hope you see that if you keep your head together and you understand these basic principles that we covered now, compound financial instruments cannot be difficult anymore. I hope you can see that. Do you think you're going to find them easier after we've been able to just decipher exactly what's going on under the scenes?
Yes.
I think we should go and practice a few.
Yes, definitely. You need to practice a few, but now at least you know in which direction you should be thinking.
Yes.
Definitely.
And not just, because can you see that there's so many different scenarios? You can't learn it like a parrot. Otherwise, you're going to make the wrong assumption in the test or exam. You're going to think it's a compound when it's not, or you're going to get so confused. But if you just keep your head together, draw yourself a diagram if you need to, because I know the test and exam, when the adrenaline's going, you don't think straight. Draw a diagram if you need to. Who's got the preference shares? Who's the issuer? Who's got the option? What would the issuer do? What would the holder do? And then you can't go wrong. Okay, so now we are doing a 180. And we are going to be looking at a bit of group financial statements. What is your feedback on your experience with group financial statements? Any comments before we start with group financial statements?
You must know your deferred tax regulations well.
Yes, very true. Anything else?
got a lot of different components to it that must be considered.
That's
Gonna
right.
say the same.
So let's have a look at some principles of groups and maybe break it down a little bit just to make it not so daunting.
Only the calculation of the second interest was very challenging. The first one is okay, like where we have the first interest is 85% and the second interest is say 70%, then it's a problem for me.
Oh, you mean changing control?
Yes, that one.
Okay, but that's not relevant for this assessment yet. So we will cover that at a later stage, but that's not relevant for today.
Let's also look at the text.
Okay, so when doing group financial statements, for your purposes, up until assessment 3, because that's what this session is all about, we basically covered a parent with a sub. We haven't done associates yet, we haven't done our joint arrangements, and we haven't done complex groups or change in control yet. So when drawing up financial statements, because you need to know how to draw up financial statements, what is your starting point? Where do you even start? And we know for every line item, you start by including 100% of the parent with 100% of the sub. Every line item. Revenue, cost of sales, other income, other expenses, income tax expense.
Except for the share capital, because that you eliminate.
Correct. But remember, that's our starting point. We haven't done any journals yet.
Okay.
Okay, so our starting point will be 100% of parent plus 100% of subsidiary. Then we do journals or whatever, or I find intergroup transactions easiest when you can do your journals, because then your journals, if you can do your journals, you know exactly which account to debit, you know exactly which account to credit, and you can simply put it straight from your journals into your financials.
Can I ask something?
Yes.
When we do the journals, do we need to show if it's the parents or the subsidiaries accounts that we're crediting and debiting?
No, you don't. What you do need to show us, though, is whether it's a statement of financial position account, whether it's a statement of changes in equity account, or whether it's a profit and loss account.
Thank you.
Okay, so because we've brought in 100% of parent and 100% of subsidiary, after we've eliminated at acquisition equity in our at acquisition journal entry and eliminated all our intergroup transactions with our journals, what's left to do? Basically our non-controlling interest. And why is non-controlling interest so important? And it always counts a lot of marks. And this is because we always start by bringing in 100% of both entities, even though we only own 80%. So where do we actually show our investors that 20% of the sub is actually owned by someone else?
It's a liability in your statement of financial position.
Remember, non-controlling interest is an equity item in our statement of changes in equity. Non-controlling interest is an equity account. That's why it's got its own column in the statement of changes in equity, because it's an equity account.
Okay.
Okay, so very important. Non-controlling interest is not a liability account. It's an equity account. It's an equity account there to show them, if you look at the financials, you'll be able to see how much of the subsidiary's equity is owned by the non-controllings. That is why.
So, and because we, excuse me,
you're welcome to talk.
Because of the starting point where we took 100% of the parent, 100% of the subsidiary, now we have to calculate NSI to remove what is not owned by the parent so that we can
Exactly.
get the exact position of the company, yeah, of the group.
Exactly. That gets separately disclosed as non-controlling because it's not owned by the parent. It's owned by the non-controlling shareholders, and who are they? They are the guys that own the 20% of the subsidiary.
And to show the portion of the profits that's not yours.
Exactly. Exactly. Because at the top of the statement, revenue, we brought in 100% parent and 100% sub. For every line item, up until income tax expense, we brought in 100% parent plus 100% sub. So where do we show to our shareholders that we don't actually own 100% of the profits of this sub? 20% is owned by someone else. We show that at the bottom because we split the profit between that belongs to the parent and that belongs to the non-controllings.
No, Lauren, and can I ask something?
Yes.
If you acquire a company, 100% of the company,
yes.
If you acquire the whole company, aren't you buying the whole number of shares and their liabilities and everything?
You are.
Okay, you only show the non-controlling interest if you are buying 80% of the company or 60% of the company.
Yes.
Okay, now I understand because I saw on top there it says 100% of, okay.
If you own 100%, if you own 100% of the subsidiary, what will your non-controlling interest be?
Zero.
Yes. But if you own 80% of the subsidiary, the rule is you still bring in 100% of the subsidiary's line items, line item by line item. But now you have a non-controlling interest to show them that yes, I did bring in 100% of each line item, but I don't own 100% of the sub. I only own 80. Therefore, 20% of the profit.
Okay, I do understand now. Okay, when you account for 100% of the whole subsidiary, but when you show that on that, I only bought 80% of the shares. So the profits of that company, 80% belong to me, 20% belongs to the non-controlling interest. Okay.
Yes.
Yeah.
And that's what you're doing at the bottom of your statement of profit and loss. That's what you're doing. You're showing your shareholders that X amount belongs to my non-controllings, Y amount belongs to my parent.
100%, it's clear.
Okay, now.
While we're on the 100%, I'm sorry.
Yes.
Can I just ask with regards to intercompany transactions, is there a difference if it's 100% or do we still need to do that whole journaling?
Okay. You eliminate this unrealized profit.
Okay.
All of it. We don't multiply by 80% when we are doing when we are eliminating intergroup transactions.
Okay. So that portion still stays the same.
Yes.
Those intercompany transactions still need to be eliminated.
Correct.
Thank you very much.
Okay, now we're going on to our controversial analysis. Now I want to hear from you guys. Who likes the analysis? Who doesn't? Yes, I want to hear from you. Who does an analysis when drawing up financials? Who doesn't like to do the analysis? Who prefers the journals?
I prefer the analysis, but it also takes too much time.
Journals.
Journals.
Definitely.
It depends on
Analysis.
Yeah, but the analysis is much easier.
Okay.
Journals. Yeah, analysis.
That's fine. But obviously, you obviously have to keep in mind exactly what they're asking. If they're asking for journals, don't do the analysis unless you're doing unless you like to do the analysis for calculating the goodwill. Some students like to quickly do the top of the analysis in order to calculate goodwill or gain on bargain purchase, and then use that to do the journal entry. That's fine.
Yes.
Don't just blindly. The problem comes in if students blindly do the analysis. You know what I mean? Just that they see, okay, it's a good question, and therefore, without even thinking, they start drawing it up in analysis. Okay, they don't even read the required first. They just start drawing up an analysis blindly. Can you see there you're definitely wasting your time because you don't even know it's being asked yet, but you're doing this analysis. And analysis, remember, yes?
It is because we're comfortable with the analysis, I think.
Yes, no, analysis is an excellent calculation tool.
Overview.
And
Sorry?
not only that, it's clearer. Everything you can
Yes.
calculate it. Even you can do the journals from the analysis as well.
Yeah, you can definitely.
Calculations are more accurate with the analysis.
And so analysis is a very effective calculation tool. But notice I say calculation tool, it's not disclosure. Okay, we will never ask you to do the analysis, ever. It's a tool that you use in the background to calculate your amounts. Okay, so you will never, ever, ever see a question that says prepare the analysis of owner's equity. What will you see? You'll see prepare the consolidated statement of profit and loss, prepare the consolidated statement of change in equity, prepare the consolidated statement of financial position, prepare the journal entries to eliminate X intergroup transaction, prepare the at acquisition journal entry. What else? Yes, that's basically all I can think of at the moment.
But we could get calculation marks for that, or
Yes, definitely, definitely. It's a very effective calculation tool, but that's where it ends. It's a calculation tool.
Sorry, ma'am,
Very
but will we get marks for that though, as you've done some calculations, if you've done the analysis, or will you get no marks for an
You will
analysis?
definitely get marks for it. You'll get calculation marks for it.
okay. So basically what you're saying is don't make the mistake of using it as your final answer. Only you use it as calculations.
Precisely. It's never your final answer.
Okay.
I did a few study pack questions and I marked myself, and what I realized, what I come to know is that if you do it under pressure, I tend not to read properly. And I think that's what you're trying to tell us. If you just jump into the analysis without taking note of what is required, you miss the opportunity to earn marks, free marks probably.
Exactly. So what I want to do quickly is I want to show you that how to use an analysis, because it's a very popular tool. Those of you who prefer doing journals, you're welcome to do your journals, but I just want to show you how effective the analysis is, especially when you are required to do something like the non-controlling interests. And as we've seen in our previous slide, the non-controlling interests is so important when it comes to consolidated financial statements. So I'm just going to stop sharing my screen with you because I want to open another document quickly. So I think, okay, so I've stopped sharing my screen for a second. Just want to go and get the other document.
May I just ask something? When we determine the goodwill, the two methods that we can use, that the company can use, and the
Yes.
non-controlling interest, when I use the analysis tool, I fumble there in terms of determining the goodwill and the NCI column. But I think we'll probably focus on that.
So you say you struggle a bit with the at acquisition portion.
Yeah, at acquisition, there's two methods to determine the goodwill. A portion of the net assets and then
yes,
fair
yes,
value
yes.
shares. And then in the NCI column, in the one it's included and in the other one not.
Correct.
So there, if I would be very grateful if we can have clarity. How do you translate that to your statements?
Okay, so what I'm going to do is I'm just going to share my screen again, and then I'm just going to open a Word document. So I'm going to close my slides for a second. Share my screen again. Okay, tell me if you can see the Word document.
Sure.
We can see it. Okay, great. So this is our analysis that we've drawn up. Now, I've given you the drawn up analysis because I want to focus on now on how we can use this drawn up analysis. Because I think that most of you are okay up to this point, drawing up the analysis. Because it's something that you are used to, you're relatively comfortable with it, you've also been doing it on a second year level. So now you've drawn up this analysis. We can see we can see a lot of things from this analysis. We can see that we've got the subsidiary, and 90% of the subsidiary is held by the parent. NCI holds the other 10%. And as I said, non-controlling interest always counts a lot of marks. So if we had to disclose the amounts in this analysis, what amount would be disclosed as profit for the year attributable to non-controlling interest?
54207 less.
Yes. Or add 493 less 798. So can you see that this 53902 is what's going to be disclosed in our statement of profit and loss as profit for the year attributable to non-controlling interests? Anyone happy with that? Because all this is the subsidiary's profit for the year of 492, adjusted for intragroup transactions, and then we get multiplied by 10% is 53902. So I just want to show you that if you can do the analysis, you can draw up the financial statements using those figures. Also, if you are asked for this 53902, why are you wasting your time doing this column? You don't need that column. So also remember to plan your answer and only do the parts of the analysis that you're going to need.
If I may ask, you have to the scenes part. Sorry about that. We don't necessarily need the scenes part.
No, because you don't need the sins part, Because if I asked you for the NCI, why are you doing the since part? You can just do the total column in the NCI column.
Yeah.
And I want to show you something else. What's the total of this analysis here? After I've added everything up in the NCI column.
Isn't it 53902?
No, look here. The total of the whole NCI column, what's that amount?
186.
212.
Will
Yeah.
that be in your statement of financial position?
And the non-controlling interest, yes. And also in my NCI column, in my changes in equity, what's the total?
186,212.
Can you see it's the same?
Yes,
Yes.
So what am I telling you? Can you see that if you can do this NCI column here, you can do the NCI column in my changes in equity, no problem.
Yes.
Because what is my balance at 1 January 2018? And I know students always often struggle with this amount, non-controlling interest at beginning of year. I'm sure you guys have too.
Acquisition to since beginning of the year.
Yes. So how do I calculate this 1,348,10? I simply take my NCI at acquisition, take another color, and I add since acquisition to beginning of current year. And I get 1,348,10. Then profit for the year, we know is 53902, 53902. Dividend paid to NCI, they would have received 10% of the subsidiaries dividend. So here's my subsidiaries dividend that was paid. NCI got 10% of that. So 2,500, 2,500, total 186,212, total 186,212. So if you can do the NCI column of the analysis, which I'm sure most of you, at least all of you can do if you've had enough practice, you can do the non-controlling interest column of the changes in equity.
Ms. Lauren, can I quickly ask?
And do very well.
Are we always going to get the current year's profit for our subsidiary, or do we have to work it
So
out?
going back to Louisa's question, what would my goodwill be? Are we using the full goodwill or the partial goodwill method here? If we look at this analysis.
If it's equity, there's a portion included in the NCI. If it's
Yes.
not, if it's a part of the net assets, then it would not reflect in the NCI column.
Correct. So if we were using the partial goodwill method here, our goodwill would simply just be this amount, 36820.
Ma'am, may you please run that again? The partial goodwill, like that, what you just said. Can you please slowly rerun it for me?
Yes, I can. Okay. So when calculating goodwill, we will always tell you the entity uses the full goodwill method or the entity uses the partial goodwill method. Now, and the correct terminology is NCI measured at fair value or NCI measured at the proportionate share of the net assets.
Is at fair value full?
Correct.
Okay, thank you.
So if goodwill is measured at fair value, it means that there'll be a portion of goodwill that relates to the NCI and the portion that relates to parent.
Sorry, if I may ask, so the equity represented by goodwill is the same as saying is NCI measured fair value. Is that correct?
No, the equity represented by goodwill, if that amount is 36820,
yeah,
then we use the partial goodwill method. If it's 39800, we use the full goodwill method.
Okay.
So, ma'am,
See the
can I
difference?
just so, ma'am, can I just ask? Remember, you said when NCI is measured at fair value, that's the full method. Is it when NCI is measured at the proportionate? Is that now the partial method?
Correct.
Okay, thank you so much.
Sorry, ma'am, I have a question.
No problem.
Please repeat that.
I'll do that. I just want to take this question.
Thank you. So in this scenario, the NCI's the goodwill is 36,820 and it is on the proportionate method, right? So that 36,820 will be recognized in the group's statement as goodwill because it is on the proportionate method. So my question is, if it's on the full at fair value, NCI is measured at fair value, will we only take 90% of the 36,820 as goodwill in our consolidated statements, or the still the full 36,820?
If it's the full goodwill method, think of it as being just for your own. Think of it as being the full goodwill method. Therefore, it's a bigger. Therefore, it's the parent's goodwill, or the goodwill attributable to the parent, plus the goodwill attributable to the non-controllings.
Okay, so in other words, we will still have 36,820 in the consolidated statements if it is on the full goodwill method. So regardless, okay, thank you.
You will just add to it the goodwill attributable to the non-controllings, and the total 39800 will be disclosed as goodwill in your statement of financial position. Can I repeat that?
Sorry about that.
So yes, no, I get you. So it's sorry.
You please repeat that,
student. So I think I missed it, ma'am. So the full the goodwill that will be disclosed in the consolidated statements, in the parent statements, will be 39,800 in our balance sheet, right? Regardless of whether it's full or proportionate method. Is that correct?
If it's proportionate method, there will only be goodwill attributable to the parent, which is the 36820.
Okay.
If it's full goodwill method, it means there's goodwill for the parent and the non-controlling interest. The total of the two, the 39800, will be disclosed in your statement of financial position.
Thank you. I see now. Thank you, ma'am.
Noted.
Okay, let's have questions. I need to clear this matter.
Thank you for explaining that.
Goodwill methods, please.
I'm sure you've seen before either goodwill can be carried at fair value, or sorry, not goodwill, non-controlling interest can be carried at fair value or proportionate share.
Hi, Lauren. I've got a question, and this refers to question 6 in the study pack 3. I'm not too sure if you've got it by hand, but
you know what? If you wouldn't mind, just send us an email, because it's going to take me a little bit of time to read through the scenario.
Okay. Okay. But can I just read a point on there?
Okay.
It says Dunn Limited Group elected a measuring NCI at the proportionate share of the acquiree's identifiable assets.
Correct.
So that is where it says the proportionate share. But they, in the solution, it's the full figure that was taken as goodwill at acquisition. It was not apportionate. So I think I'm also confused. But maybe
That's
I should say
strange, because it should be the if they say proportionate share, it's the partial goodwill method, and therefore there should be no goodwill for the NCI. For the NCI.
Okay, so there is no goodwill to the NCI, then I'm on the right track. Then there is no goodwill for the NCI, and it's not apportioned according to the percentages. So the full 5,800 is then the goodwill.
Correct.
Okay, thanks. I've got it. Okay, thank
Yes,
you.
I looked quickly at the
Sorry.
solution. It is correct. It doesn't show the NCI portion.
Yes,
That's
it
correct.
doesn't.
That's correct.
Yeah, so maybe students can also just look at that to get a better understanding. That's like a direct example of what we're discussing now.
Okay, cool, perfect.
Sorry, ma'am, can you please clarify for me in simple terms the difference between these methods, like when it comes to the goodwill? Because I see the example here, but I just the meaning and the definition behind for me.
Okay.
Would you mind if I quickly budge in?
You're welcome.
You can tell me if I'm wrong, but the way I remember it, that's easy for me, is if they give you the fair value of NCI, then usually there is a difference between your total after you give NCI the portion of the share capital and the retained earnings and everything. Then that total differs from the value they gave you as the fair value of the non-controlling interest. And then obviously there's a portion missing, and that portion is goodwill. Is that right? If they give you the value of the non-controlling interest fair value, then there is a portion of goodwill.
Okay, just be careful.
Usually.
What happens if we give you the fair value of non-controllings, but we also tell you that non-controllings are measured at proportionate share? Can you see we're actually just testing you whether you know what to do?
Yes.
Okay, so just be careful about saying if we give you NCI fair value, it is full goodwill method.
Okay.
We might just be giving you both options so that we know that you know to choose the correct option.
I understand. Thanks.
Okay, so quickly, let's spend a few minutes on this because I know that goodwill and gain on bargain purchase count a lot of marks. So it's very important that you are able to calculate goodwill gain on bargain purchase at acquisition date. So let's start from the beginning and say, okay, this subsidiary, what was their share capital at acquisition date?
125,000.
Yes. Okay, so that's given to you in the question always. You know how to calculate it. What was the retained earnings at acquisition date?
309,200.
Yes. They must have had some sort of asset. Can you see that? That was not at fair value in their books.
But if I may ask on that, at times we are being asked to calculate the retained earnings with the total. Is it possible that we will have the circumstances whereby we don't have the retained earnings, the total, whereby we have to calculate it first?
No, we'll give it to you.
Okay.
Okay. Here, in order to make this adjustment of 36,000, I don't have the question because I don't want the question at the moment. But we must have told you that there was some sort of asset with a fair value of 250, a carrying amount of 200. So what do we need to do at acquisition in terms of IFRS 3?
Fair value the assets and liabilities.
Precisely. We can't use the carrying amount because then our goodwill figure is going to be wrong. We need to fair value the asset.
And we need to remember deferred tax as well.
Correct.
And how that asset will be exposed
Realized.
of through realized through sale or through use.
Precisely.
Yes.
Precisely. What did we pay for this for our 90% interest in the sub?
460,000.
Correct. That's amount there. And what is our non-controlling interest at fair value?
39,800.
50,000. Can I go through the calculation with you?
Yeah, no, yes, please, I would love that.
May I just ask, if it's not applicable, we can just scrap it. But can there be market-to-market reserve there as part of at acquisition?
There can be. All mark-to-market reserves, don't be scared of it. It's just another equity item.
Okay. Through OCI, I presume.
Correct.
Okay. So we just handle it as retained earnings.
Correct. Correct.
No problem.
No problems.
Okay, I've got another question. Sorry.
Just hold on 1 second. I just want to take a step back and just calculate this 50,000 Rand for you. This 50,000. So this is non-controlling interest. This is the fair value of the non-controlling interest, the 50,000. So the non-controlling interest owns 10% of this 125,000 is the number of shares. So they own 10% of 125,000 shares, and the fair value of each share is 4 Rand. Can you see how you get to the 50,000?
Yes, I do.
Yes, ma'am.
Okay, I just wanted to confirm that you guys can all calculate the 50,000 because that's very important. Okay, questions?
Ma'am?
Yes.
Can we just go through the mark-to-market quickly?
How
does that work?
You know what? Don't worry about the mark-to-market. I'll tell you why. SAICA have actually said in their examinable pronouncements that investments measured at fair value, in other words, that need to be mark-to-marketed, are not examinable.
So we won't get it in the assessment or in the exam?
No.
Okay, because I went through activity 8.4 question 1 and there is a mark-to-market in there and I struggled with that.
Okay, don't worry about the mark-to-market. It was the reason it's there is because it was there in prior years, and obviously these are prior year exam papers. But for this assessment and the exam, you don't need to worry about mark-to-market.
Okay, thank you so much.
Sorry, ma'am.
Ma'am,
The
if I may
50,000
we
you
please
said
go through
on
that
the
evaluation
balance sheet.
surplus again?
Just hold on, just one.
I was asking, ma'am, the 50,000, you say we will recognize it as what on the journals, ma'am?
The 50,000.
Yes, ma'am.
The 50,000 is non-controlling interest at acquisition date.
Thank you, ma'am.
And if I'm sorry, where did you get the 4 Rand? I'm just confused there.
Oh, that's always given in the question.
Okay, noted.
Oh, I also wanted to ask regarding the revaluation surplus. Can you please explain that again to us? I'm trying to understand the 72% there.
Okay. This was an asset that was revalued by 50,000 Rand, which means our revaluation surplus at acquisition is 50,000.
Yep.
We know that revaluation surplus is always an after-tax amount.
Okay.
Hence, we multiply by 72, and this which would actually be now 73 based on the new tax rate.
Okay. All right. Okay. Thank you.
And if we had to do our at-acquisition journal entry, can you see that you can use these figures? All these figures here. Well, the 125, you would debit share capital with 125 to eliminate it. You would debit retained earnings with 309,200 to eliminate it.
Sorry, can you please share this question in the chat, please? Thank you.
So when you say share the question in the chart,
Sorry, ma'am.
I'm just want to
I think
clarify.
she's using the Teams chat.
I
think she's using the Teams chat.
I actually didn't want to share the question with you because it's a long question and to have to go through all that information. I just wanted to show you how you can use the analysis to what you can use the analysis for.
Can you share the question so that we can do it on our own?
Fred
I can do that. I will definitely share the question with you. You must just remember that it is an old 3704 question. So just be careful that the tax rates are will be different because this was based on the old 20% tax rate. But other than that, you'll be able to, I can share the question with you.
Sorry, ma'am.
Yes.
Can I quickly ask on the why am I hearing myself? Can you hear me?
I can.
On the revaluation surplus, when it is through sale, we include the 80%.
Correct. So that would be example
We receive
land.
profits through sale.
That would be, for example, land.
Yes.
How will you recover the carrying amount? Through sale or through use?
Yes. When it's through sale, you include the 80%. When it's through use, it's only the 27%.
Correct.
I'm
Okay, I just wanted to make sure.
Can you please repeat that? I'm kind of lost. Sorry.
Okay, no problem. It's just which tax rate do you use when? When do you use the capital gains tax rate and when do you use the normal tax rate?
Okay, no tax.
That's what we are discussing. Okay, so I will definitely share this question with you, but the crux of the whole exercise was just to show you how useful this NCI column is, particularly when drawing up your NCI column and your changes in equity.
Ma'am, I have a problem here. 90% of the goodwill is not 36,820.
Okay, so I just quickly want to, we're not going to be much longer because I see we have reached 11, but I just want to quickly run through some intercompany transactions with you, specifically journal entries. So intergroup transactions. In this instance, Alpha sold inventories to Betty. So Betty and subsidiary Alpha, so Alpha is the parent, Betty is the sub. And Alpha sold inventories to Betty, so the parent sold to the sub, profit of 25% on the cost price, and they give us the intergroup sales for the period ended 20.8 and 20.9. And they give us the inventory on hand for both periods. And we say prepare the intergroup journal entries.
Is it 100%?
It doesn't matter when doing these intergroup journal entries. It only matters when calculating your non-controlling interest, which we're not doing here. So if we say prepare the intergroup journal entries, it doesn't matter what percentage the parent holds. You will eliminate all of the sales between the two, and you'll eliminate all the unrealized profit between the two.
Okay, thank you.
Okay, so our first step is to eliminate the total sales between the two entities. And how do we do that? What was the total sales of the year between the two entities for 20.8? 850. So we need to eliminate that in total. So we debit sales. Can you see by debiting sales, we are reducing sales? For revenue. Revenue is actually the more correct account. Debit revenue 850, credit cost of sales 850. Then we need to eliminate our intragroup unrealized profit in the closing inventory. What is our closing inventory at 31 December 20.8?
300,000.
So we take 300,000, we multiply by what profit percentage do we use?
25%.
25 over?
125.
25 over 125.
125.
If it was 25% on the selling price, what profit percentage would we use?
25 over 100.
Yes.
Also, there's some cost. Okay.
So we're going to debit cost of sales because we're going to increase our cost of sales. Why do we want to increase our cost of sales? Because we want to reduce profit by 60,000. And credit inventory, if the sale had never happened between the two entities, our inventory would be 60,000 Rand less. So we credit inventory with 60,000.
Cool. So does it mean that our inventory is decreasing?
Decreasing, yes. Because think of it this way. Alpha and Betty are their own entities. For consolidation purposes, we are drawing up financials as if they were one entity. Can you sell to yourself? No. Therefore, we eliminate the sales between the two. Also, can you increase the value of your inventory because you went from one room in the company to the next room in the company? And the answer is no. So for the same reason, you cannot increase your inventory value because it went from alpha to Betty. We need to bring the inventory back down by 60,000, which is the unrealized profit in the closing inventory.
Okay, noted on that one. I think I follow.
So, ma'am, can I just ask one question? We're debiting cost of sales to eliminate the unrealized profit in the closing inventory. That's why we're debiting a cost of sales to reduce the profit. Okay. Okay, thank you, ma'am.
Because the only reason why we eliminate intragroup transactions is because for group purposes, none of these transactions ever took place. And so all these intragroup, all these journals, all what they're doing is taking them out as if they had never happened.
Okay, thank you, ma'am.
Ma'am, hi.
Hi.
Can we redo how we calculated the 60,000?
Yes. I'm gonna the 60,000 is the, I just want to get the amount again. 300,000 times 25 over, it's on the cost, so over 125. And that should give you 60,000.
And the 16,800?
That is 60,000. I think it's on the old tax rate. So that would be 60,000 times 27%, sorry, 28%.
That's cool.
So for your purposes, using the new tax rate, you would say 60,000 times 27% gives you 16,000 200 using the tax rate that you would be given in the question. Does that make sense?
Yeah, right. But we get 16,000. Oh, yeah. Sorry about that.
Yes.
Right.
Okay.
So why do we credit the income tax expense, if I may ask?
If we look at this, what do we do? What is the 60,000 rand doing to our profit? Increasing or decreasing it?
Decreasing.
So what is happening to our income tax expense?
It's decreasing.
Yeah, so we debit it.
Noted.
And the other leg is deferred tax. That's how I like to remember it.
Okay. Thank you.
And then you can never make a mistake as to what to debit and what to credit.
Just a question: doesn't change the actual income tax that either company has to pay to SARS?
No.
It's just an intergroup for the consolidated financials.
Correct. As if these guys are one entity.
Okay.
Ma'am,
Yes.
does that mean that the deferred tax is a deferred tax asset?
Correct.
And it's increasing the deferred tax balance.
It'll be a deferred tax, which means it's a deferred tax asset, yes, which means that it'll either increase your deferred tax asset or reduce your deferred tax liability.
But only in your consolidated financials, not in the either the parent or the subsidiary.
Precisely. Intergroup, these journals are not done in any separate entity's books. These are done for consolidation purposes only.
Presentation purposes only.
Correct. They're not actually passed in the separate guys' books.
Okay.
And you don't indicate whose sales and whose inventory and that are you.
No. But please do give us which statement it relates to. So you'll say revenue is actually the correct terminology, debit revenue, SPL, etc., etc.
On the statement of profit or loss, will this income tax expense entry be shown?
Yes.
Okay.
Okay, so I'm just going to have a look at a quick example where we're now selling an office building, because I see we are running short on time a little bit. Let's say this is not inventory between Johnny and Walker. This is now an office building. And what profit did Johnny Limited make when he sold this building to Walker?
5,000.
Yes. So I need to get rid of that profit, don't I, in my consolidated financials.
Ma'am, will you have to use capital gains here as well for the deferred tax?
No, not for the office building, but we will be very clear whether you must use capital gains tax or not.
Could you kindly show the calculations there? How did you get the amount?
So which amount are you referring to?
I beg your pardon?
Which amount are you referring to?
So the one where you subtracted the profit.
The 5,000.
Dis 15,000. Dis derde jaar. Surely jy kan gewone plus en minus.
Ma'am, we can hear you. We can hear you, please.
Please mute yourself before you, yeah. Okay, so we said debit profit on sale of buildings, other income 5,000.
Yes, ma'am.
credit PPE 5,000.
Noted.
The 5,000 is the 20 minus the 5. So it's basically the profit that Johnny made.
Okay. Okay.
I just want you to see the two legs of the journal. By debiting other income, can you see we're reducing profit by 5, which is what we want to do?
Oh, yes, I see that. I see that.
But look at this credit PPE. What are we doing? Why do we credit PPE?
Because he sold the property.
Yes, and if it had never been sold between the two, what would the carrying amount be?
15,000.
15,000.
What is it now?
20.
Yes, can you see? I'm bringing it back down from 20 to 15. As if the sale never happened.
Oh, yes, yes, I see that now. I see that. Okay.
I need you to see that because I know some students miss it. So can you see that's exactly what I'm doing in the inventory?
Yes, ma'am.
I'm bringing it down as if the sale never happened, which for group purposes, the sale never happened. And then I like to say, what did I do to my income? I reduced it. Therefore, what's going to happen to my tax? It's going to reduce 5,000 times 28%. So for your purposes, it will be 27%. We'll give you my correct.
Well, ma'am, so the property is still within the group. But
yes.
The property was at fair value 15,000. But now on the group side, it looks like it's 20,000. But actually, it is still 15,000 because the group never sold to each other.
Precisely.
It's as if, yes. I understand now.
Okay. All of this, all we're doing here is we're saying, what would the financials look like if these guys were run? What happens if that sale happened last year? Would we still do the journal again? And the answer is yes, because there's another important principle going on here. And that is that consolidated financial statements are done from scratch each year. So what I passed last year is no longer there.
So this is the following year, right?
Yes, this is the following year. So in the following year, what am I going to do? I'm going to say, okay, what did I do last year? Last year, I debited my profit and I credited my income tax. Where would this be sitting this year? In my retained earnings, wouldn't it?
Yes.
So what must I do to my retained earnings?
Debit.
Debit with 3,600. What did I do to my deferred tax last year? I debited with 1,400.
Yes.
What must I do this year?
So this is
1,400.
The 1.4 with the 5,000.
And last year I credited PPE with 5. You may. This year I'm going to credit PPE with 5. Yes, questions.
Sorry about that. So don't
your retained earnings would be your balancing figure in this case, because you would have had the 5,000 from the previous year and the deferred tax for 1.4, and retained earnings would be your balancing figure per se.
Correct. It's the sum of what you did last year to your profit.
Okay.
Or is it the other way around? Can I just interfere as well? Sorry about that, ma'am. Don't we take the amount for the income tax expense, which is the 1,400 and the one under the PPE? No, not that, man. I mean the profit on sale, which is 5,000, as well as the deferred tax, which is 1.4.
Yeah.
Those two.
To retain earnings, yes.
Oh, okay. Is that? Did you answer me, ma'am?
Yes, I said yes.
Okay. Noted, ma'am.
Hi, ma'am.
Yes.
Just clarity. So I realized that when we do the elimination of intra-group sale of inventory, we do eliminate the revenue. Sorry, the sale by debiting revenue and crediting cost of sales. However, I don't see us doing that in the case of us selling depreciable assets like PPE assets, like in this case where we are selling the building. Why is that the case?
What would you want to debit and credit? Because look here, we've taken out the whole profit of 5, we've eliminated.
Yes. So the actual sale of the 15,000.
There's no account that would be included in. So therefore there's nowhere to eliminate the 15 from, or the 20. Because if this was inventory, you would eliminate the 20,000 from cost of sales and revenue. But if you think the journal entries that were passed in the separate financials, nowhere did we account for that 20. So there's nowhere to take it out from.
Okay. All right.
That makes sense.
If you put it that way. All right. Thank you for the clarity.
Just a question, ma'am. When we're looking at the elimination of the owner's profit in this PPE, and if we need to post this amount to our statement financial position and the PPE, what are we disclosing here? The 15,000 or the 20,000?
In your PPE,
yes,
starting point will be 100% parent plus 100% subsidiary. So that would be, so included in there will be 20,000. And then you'll say minus 5,000 because of your intergroup journal.
So we're disclosing 15,000.
The only asset or the only PPE of the group, my group's PPE is going to be 15. 20 minus 5.
Okay, thank you.
Can I just, okay, sorry.
So ma'am, in this instance, the person that actually benefits for the enduring that has got an enduring benefit on the asset is non-controlling interest. They benefit on an asset that was handed over to the other entity without the entity enjoying the profit of that asset.
I'm not 100% sure what you're asking.
I'm saying if I've bought a company for 60%, even I still have to eliminate intergroup profits.
Yes.
And I'll eliminate that 5,000 holistically without taking into account the non-controlling interest. So the asset is moved into a new company that actually the non-controlling interests are still benefiting on the profitability of that asset. Not 60%, but the whole asset. They are benefiting from it.
Yeah, because the non-controlling interest share in the profits of Walker the sub, and Johnny sold the building to Walker.
Okay, I see.
Is it, am I understanding correct that these intergroup transactions, it's on the profit and loss, so the non-controlling interest is only taken into consideration when you do the statement of financial position, but initially the profit and loss, when you do the consolidation, you add all 100% and eliminate the intergroup transactions.
Correct. I just want to see. Okay, this is exactly the same, but a machine. So let's do our last intergroup transaction. And this is a machine that's sold from one entity to the next. So this is a depreciable asset. So you'll see that my journal entry to eliminate the unrealized profit is exactly the same as with any other asset. What about this depreciation? Can someone tell me what are we doing here? Because I want to just focus on this journal. This is a depreciable asset that was sold from one entity to the next. And I just want to focus on this 1,000 because I know that students struggle with this as well. When we say credit accumulated, credit depreciation, what are we doing?
Increasing the profit.
Why?
No.
Realize the profit.
We're realizing a portion of this unrealized profit, but why are we doing that? Why
depreciation down?
Yes. So let's just recap that. We are bringing the depreciation down. Why are we doing that?
To eliminate it.
Because they recorded more than they should have.
Exactly. Well done. What is the carrying amount in the separate financials of this machine?
20,000.
20. What should it be for group financial purposes?
15.
15,000.
15. So our depreciation, when Captain did his depreciation for the year, what amount did he base the depreciation on?
20.
What should he have based it on for group purposes?
15.
Yes. So can you see it's the difference between the depreciation on the 20 and the depreciation on the 15 that we are accounting for to get to our group financial statements. We are reducing the depreciation
Sorry, the depreciation for the first year would have been, if the asset was 20,000, would have been 4,000. But actually, because this belongs to the same group, it must be 15. So depreciation would have been 3,000. So we are taking that portion that was actually included, taking it out of these statements, aren't we?
100%, 100%. And then the tax follows that.
Noted.
Ma'am, if I understand you correctly, so if you're saying that if this particular group that we're doing here is that because the asset was sold to the same group, the carrying amount,
yes,
the 15,000, right, is what the asset is to the group. Therefore, the depreciation should show. I'm trying to understand how we move from the 4,000 to the 3,000 depreciation. If initially it was 20% on a straight line method, which is 20,000 divided by 5. I don't know, maybe I'm just over complicating this.
But you're 100% correct with your first thing. You said in the group, the machine needs to be reflected at 15,000.
Yeah.
In the separates, it's currently sitting at 20.
Yeah.
So in the separates, Captain would have said 20,000 times 20% is 4.
Yes, that's correct.
So in Captain's separate financial statements, he's already accounted for depreciation of 4.
Yes.
How much do we want in our group? Depreciation of what? 15,000 times 20%.
Okay.
And therefore we need to reduce our depreciation in our group's financials with 1,000.
Can I just ask if the useful life is different from the parent and the sub? How do you approach that?
The same applies. You'll calculate what it was in the parent, what it should be in the sub, in the group, and you'll account for the difference.
Ma'am, can I please
And do we do this every year?
Correct.
The adjustment of depreciation, do we do it every year?
Yes.
Okay.
Ma'am, Can you please run through the deferred tax journal for me that follows the 1,000 Rand reduction in depreciation?
Yes.
Why are we debiting tax expense, and why are we crediting deferred tax again?
Okay. What I like to say to myself is, okay, we are crediting depreciation. So what does that do to profit? Increase or decrease?
It decreases
Decrease in profit.
your profit. It decreases your profit.
No, look, we are reducing an expense.
Oh, reducing an expense, sorry. Yes.
Increase profit, therefore increase tax, debit income tax, other leg deferred tax.
Oh, so when you reduce your expense, obviously your profits will go up and then you'll have to pay more tax.
Correct.
So, oh, thank you so much. Thank you.
So maybe we should ask
Ma'am?
ourselves what's happening to profit every time we do one of these.
That's what I like to do. That's what I like to do. Then you can never go wrong as to what to debit and what to credit.
Ma'am?
Yes.
Ma'am?
I can hear you.
Hello?
I can hear you.
Why do you say that the profit that was not realized is sitting in our accumulated depreciation of the buyer and in the depreciation of the seller?
It's not actually either one. It's in our group. We are reducing depreciation in our group, and we are reducing depreciation, accumulated depreciation in our group.
In our
Don't say it's this one of this entity and that one of that entity, because none of them are actually done in anyone's financial statements. Neither leg of this journal is passed in anyone's financial statements. It's done for the group. So we're going to reduce accumulated depreciation in the group and credit depreciation in the group.
So what happens to this depreciation and accumulated depreciation when we sell the asset outside the group?
When it's sold outside the group?
Yes.
Okay. Just remember, consolidation is done from scratch every year. Okay? So if this machine is now sold outside the group, can you see that you won't need to do any more adjustments because this is now sold outside the group?
I'm sorry, you're not audible. There's
Okay.
something wrong
You
with
know what, I'm going to pause on that question because that question is going to open a whole can of worms.
Okay.
But basically what I want to give you the principle is that.
All right, thank you.
Yeah.
Okay, can I just quickly ask lastly, can I just ask on we haven't reached that part, the 280, I'm just confused how we got to that.
Okay, for your purposes, I think you would use 27%. So you would say 1,000 times 27%. So you would say is 270.
Sorry, ma'am, I think I'm a bit slow. Can you repeat the 1,000 accumulated depreciation, ma'am?
Okay, I'm not going to repeat it right now because you can send us an email and I'll explain to you because I see we now are nearly 35 minutes over time. So I think we need to start closing off.
Ms. Lauren, before you start closing off, are we going to get these slides?
Yes, I will post them for you.
Thank you so much.
I'm going to share the question now as well.
I can do that.
The groups one with the memo.
I can do it for this afternoon.
Okay.
Is there a
So you
solution to the
spend most of your
question?
time doing financial instruments and groups. So is that where most of the marks are going to be?
No, I can't say that. What I can say is that I think it's where students struggle the most.
What's the weighting of groups in the test out of 60?
I don't know, to be honest with you.
Sorry, Monsieur Don, but if you were us, lecture 1 to unit 1 to 8 is quite a lot of work. Would you focus more on the newer work that we've covered over the last few weeks, or how would you approach it?
Yes, I will definitely focus on the new work. but don't only focus on the new work. Otherwise, we wouldn't say learning unit 1 to 8.
Ms. Lauren, you sound like a politician now.
I'm trying my best.
Ma'am?
Yes.
Yes, so the recording of the lesson that took place on Wednesday, the 13th, hasn't been uploaded.
Yes, I owe you that. I need to post it with this one at the same time.
All right, thank you so much.
Okay, guys, thank you so much for your input. I really enjoyed having all the feedback and input that I did this morning. And please, thanks so much for everything. I hope it did help, even just 1 or 2 principles to make them a bit concrete. And very good luck for Tuesday. You won't not that you need luck, but you'll be fine. It's a very balanced question paper. I don't know. I haven't really looked at it in detail, but I have glanced at it. And
when are you gonna post this recording?
I'll do it this afternoon.
Thanks.
Okay, guys, wouldn't mind just telling us where we can perhaps improve, what you found the most valuable, where you believe we can improve for future classes, and that would be much appreciated.
I think this one was the best class because everything was explained, the concepts were explained in clearer. It was not a hurried class. All these other classes are hurried and the concept are compacted in 1-2 hours, and I mean it is frustrating. So this one, it's quite clear. So thank you so much.
I hope it was clear.
Absolutely agree.
I hope it was clear.
Hi, ma'am.
Thanks very much, guys. Enjoy the rest of your Saturday. And I hope the sound wasn't too bad in the end.
Thank you. Bye-bye.
Thank you.
Bye. Thank you. Bye. Bye.
Thank you. Bye-bye.
I thought it was